Rick, great to have you on Friday Jobs Day, and especially on one with such good news for the labor market and for the U.S. economy. What do you make of the non-farm payrolls?
So, Matt, it's a solid number. And I think one thing I always find it interesting when you get the top line, but then it's like markets, like all the money is when you get underneath the surface. It's a fascinating report in a couple of different regards. When you actually look at it, so, we know healthcare, we talked on the show all the time. Healthcare, good again, check. Local government was a big number this month, so it was about 50,000 jobs, local government. So what do you do with that? Interesting, that tends to move around, obviously. But then when you get underneath the surface, I find it fascinating, a couple of things. Construction was strong. Why is that? And you dig into construction and you look at it, non-residential construction is strong, meaning AI, build out, which we know is coming, which we know is happening and will continue to come. And then you look at underneath and you look at real estate softer, and then you look at residential softer. And then a thing I also thought was fascinating, I think you mentioned the finance jobs softer. Then you dig into finance, what's happening? Insurance was pretty soft, which is a trend you've been seeing. Why is that? It's AI sensitive. These are the areas and services where you're going to start to see the softness. You're going to start to see AI start to press on the areas where you can create some real efficiencies, real productivity. So net, solid number. Things like food and drinking, I don't know what was happening that created that sort of hiring. That was solid. You got to factor that in your equation. So anyway, point being, I think you got to factor, you got an economy that's doing quite well. You've got an AI, you've got a big cylinder of AI that you see show up in construction, and you see that what companies are doing that are starting to implement. And I think you got to think about the Fed's reaction function. The data so far is solid, and you got to build that into your positioning.
I don't know about what people were doing with food and drink. I guess some celebration with indexes at all-time highs. I'm always tracking G-body 911s. Even the 997s are at prices that I just can't believe. There's a lot of cash out there, Rick. I look at credit, right? The ag at 30-year tights right now. Where is all this cash coming from?
Matt, you brought up, there are a couple of very relevant statistics today. The money market fund number is extremely high. And by the way, I stare at it. It's one of the numbers I stare at every week. And the inflows in the money market funds just keeps coming. By the way, you got a strong economy that is supporting that. So you got money market inflows, bank deposits, very solid. The other thing that you see that happens, we track in the market, why is all the supply well subscribed in fixed income? You see the pension demand, the life insurance demand, you're at yields. If you're matching a liability, you've got yields that are pretty attractive, even though spreads aren't that interesting. So you've got two big pockets of demand, particularly for fixed income, and then for equities, I've said it before, even though you're getting IPO calendar, so a little bit of digestion, you have so much in the way of buyback that the net supply of equities is just not that large. So, not to say you can't pull back on numbers like this or war-related issues, but the technicals underlying the equity market are pretty solid as well.
When you come on, Rick, my IB just lights up. Viewers writing in with about 1,000 questions here, so get ready. What's your view on all the investment-grade data center issuance? Is it overweight because that's the future, right? Because that's the dream and it's going to come true, or you be more cautious because you see so many more deals?
It's a great question. So, one, I think you got to build that into your duration, your interest rate exposure that you take into portfolios today. Meaning, you got to supply. We talk about there's a lot of Treasury supply that comes. There's a lot of financing that's coming to support this data center bill that just showed up in the employment report today. So I think you got to think about how much interest rate exposure I have today when you're pushing a lot of supply in the market. Maybe I run a little bit less rate exposure, which I think makes a ton of sense. And then, listen, I think it's mixed. Some of the, quite frankly, some of the supply in investment grade is okay. There's, because people don't have a lot, you get some demand for that. But, some of the, some that comes in convert form, very interesting. If you get equity upside alongside of it and a coupon, that I think is super interesting. And then, quite frankly, some of the quasi-private, some of the more off-the-run data center finance, that I find more interesting than just the regular way auctioned investment-grade debt.
Let me also ask about I had a trader write in, Anthony Santos Stefano, about the Japanese yen when we got this jobs number across, because it gives strength, right, to the dollar. That makes the yen weaker. Right now we're at 160.07, and they've already blown through like $75 billion in foreign exchange reserves. If they go in to defend this here, they're going to have to sell more treasuries, right? What does that do to yields?
So, I would say a couple of things to that end. When we look at U.S. rates, I think the thing you got to respect today, you got the Bank of Japan that's raising rates, the ECB, the RBA, the Bank of Canada. So you're in a cycle today, and you've got a fiscal dynamic that I think you have to respect if you're the U.S. rates market. So that's one part of it. Listen, the yen, we spent a bunch of time looking at it, and, how much risk do you take in JGBs, and how do you hedge it? Listen, I think one of the things, we need, Bank of Japan's been a bit deliberate on moving rate like they need to in terms of getting that rate up. And so obviously the derivative impact, you see that play out in the currency. So listen, we follow it obviously closely with positions in it, and we look, we watch it pretty carefully. And I think, listen, there's one thing that is beneficial, and one of the ways I think Japan is very interesting is on the equity side. Like, I think, you see that sort of price action in yen, and you think about the beneficiary thereof. Listen, I like Japanese equities. Rates is particularly front-end rates is a pretty tough trade.
What are you doing in Bink right now, Rick? You've been outperforming the market in your ETF. Yeah. What moves are you making that you can share with maybe your competitors who are watching?
Thanks for that. I'd say a couple of things. Listen, I think, we've moved our interest rate exposure sympathetic to get a strong economy. We've reduced a decent amount of interest rate exposure. Some of the negatively convex to rates, agency mortgages, which, is a good asset class. We like it. Today, maybe we want to be, and, we have been a bit more cautious about that space. I like Europe in a relative basis. Europe's already priced in the hikes. We get debate, do they have a lot more to do? I think European fixed income is quite interesting because you've already priced in the hikes. And so that, we like that quite a bit. And then EM, obviously you got to manage the currency and think through it. But actually, I would say we've been pretty neutral on EM, but, we have, higher exposure in EM than we've had historically, albeit that's not a huge position for us. But big moves, watch your negative convexity and interest rates. Europe's got it more priced in than the U.S. And that's we think the ballast and the carry that comes from Europe fits a portfolio nicely.
Does the war make any difference to your investment strategy? I mean, if we just sit in a ceasefire where we shoot at each other for months and oil holds around 100, does that matter?
Yeah, what really matters for the markets today, is obviously what the forwards are going to be in oil. So you think about what are your inflation break-evens and how do you, so, we watch the forwards pretty carefully in terms of where that goes. So, yes, that's important. If you stay in a range, markets, to your point that you made earlier, there's so much cash in the market. As long as you believe that it's in this stasis, even if it is, similar to the Ukrainian situation, then market's generally okay. It's the shocked that it's going to move one way or another in a significant fashion that obviously you've got to be sympathetic to on portfolio. I will say we've built a lot of, what's happened recently is volatility's come down in the equity market pretty markedly, not so much single name, but in index. And so you can start to use volatility to protect your left tail, to protect the downside in the equity market. So, we've done some of that, particularly when you have, the news around it is we're not really going anywhere. I'm
looking at the forward curve on Brent. Anyone can do this on the Bloomberg terminal, by the way. Just type CT for the contract table on a commodity, and I see we don't get below 80 until 27. What about SpaceX? What about, an IPO that sucks that much liquidity out of the market, especially if you have 3 of them in a row? Does it matter to fixed income?
It definitely matters to equities. I was thinking our equity portfolio, whenever we think about, a name like this and it's a name we've been involved with and others are involved with. And so, you got to think about it within the portfolio and think about, how much, what else do you own and how do you manage that? Or when you think about new issue that comes like this. So it obviously matters to supply and demand in the equity market. In the rates market, the fixed income market, I think there's one thing that does I mean, equities have taken you to such an elevated position. If you're a pension, a foundation, endowment, and then now you get to a place where you're fully funded in some places. And when rates back up, your real rates, now we're at levels that are pretty darn attractive if you're defeasing a long-dated liability stream. So, you know, I think what a lot of people are thinking about, like, boy, this has been a pretty positive, pretty powerful period for equities, including some names within the portfolio, or names that are doing well. You know, fixed income, when you keep elevating these rates and you think about your real rate and gosh, with even if inflation's running a bit elevated, if you can build portfolios, some of what we do in bank, if you can create 6.5, 6.75 yield, boy, it's pretty attractive.
I mean, it seems like AI isn't just bullish the economy, but changes the trajectory at which we operate, if they're true.
I mean, listen. I mean, I went through the data and I talked about a presentation I gave where I looked at, if you take AI related the last 3 years, it's just about 28% of the growth of an economy that's a well over $30 trillion economy. You think about how big that. I mean, how can that be? And by the way, about 70% of the return of the S&P. And then you think about every part of the economic ecosystem today. You think about how AI, the spend and the capex. And then, you know, per the number today, you look at the companies that are starting to adopt it and how it impacts everything. And we talked about insurance. We talked about the impact that's having on some of these services, software, et cetera. Boy, it's become, you know, the thing I would suggest, though, you have an economy that's operating on that cylinder and the rest of the economy is just okay. You know, I always talk about small business, not great. Young people, lower income, not great. But boy, that part of the ecosystem is humming. The numbers are mind-blowing. I mean, every day, including weekends, we get calls on financing that's got to come to the market. It has become pretty impressive. Well,
and we see, I mean, you were talking about construction jobs, Rick. It doesn't seem as concentrated as the naysayers are worried about. Like, we look at companies that do HVAC, that make boilers, and they're rallying hard. You know, Ford Motor Company has become an AI play because it makes big batteries that data centers can use. Caterpillar, Deere, all of these old economy. I mean, yesterday we saw the Dow Jones Industrial Average up 900 points. What do you think of this rotation?
So I think there's a lot that makes sense in what you said. So you think about, there was the first level, you think about semis, you think about the direct beneficiaries, and then you look at things like electrical equipment, you mentioned cooling, like the infrastructure build. Like, I think the thing that makes sense was people are starting to count, and you're seeing the numbers of these companies that are reporting, the companies that are tangential to AI, or maybe not anymore, maybe their business actually, in some of them, has become directly top-line revenue related to AI. Like, that's where, quite frankly, the multiples are not as egregious today, and obviously power, and that there is the demand function for those products. And by the way, related to space, you look at the components there as well. Like, those companies become pretty interesting today as people start to think about, okay, I need to diversify a little bit. I've got concentrated risk in some of the parts of my equity portfolio. Yeah, I think it's real. But again, it gets to the point of, like, you got one big cylinder that's driving so much of the economy today.
It is driving so much, though, and I think that's the point. I mean, are there areas that AI is going to miss, Rick? Are there industries that you're worried are left behind? Do you worry about AI eating jobs in some places?
Man, you know, I think, people talk about the K-shaped economy, and I actually think that visual is not that great because it suggests that the lines are equivalent on both sides. I actually think that the economy today is more like a 3-month-old birthday cake. The icing's great, but then you look underneath, which is the bulk of it, and it's actually not doing so well. I mean, the thing that is tricky today is I think you're going to displace a lot of workers. And I think, part of what the Fed's job and otherwise is be a bit anticipatory of where we're going and how it affects the broad population at large. And I think, obviously we and every company uses AI aggressively. And you think about, including this morning, I was going through with a member of the team, gosh, I could do this now, I could do that now, I don't need to go to. It is going to change the ecosystem, and you're seeing productivity that's heretofore kicked in. By the way, robotics, automation, all powered by that same ecosystem. That, listen, I think where we're going, and by the way, when you think about the economy today, you've also got a big fiscal tailwind. When you think about where we're going the next few months, I think you'll have somewhat different disposition around that. So anyway, point I would make, if you're the Fed, I think you got to pull back. Maybe you're on hold. Like say, I position for what could be a Fed that's more hawkish. But gosh, I think you gotta think about where are we today, what's being impacted in the economy, the people in the economy, and then and give it a bit of time to evaluate the condition.
But are you saying? I mean, it looks like we're adding so many jobs, and inflation is still way too high. You don't want to be cutting, right? You kind of, if anything, you have to raise into this, don't you?
So my personal view is when you look at the broad construct and you look at what the interest rate tool really impacts, is it affecting the AI spend? Is it affecting the infrastructure? Is it really influencing? Does you move the discount rate? Does it really influence the hyperscaler demand? Really not. It influences housing, where you're seeing that. It influences, obviously, small business, where you're seeing it. You look at credit card charge-offs. Anyway, so what do you do with that? I think you got to take the whole equation and say, my personal view is, well, obviously, inflation is above target. Obviously, growth, fiscal tailwind is solid. I think you just got to give it a little bit of time. No, you wouldn't cut, obviously, into this. Do you need to hike into it? And by the way, you look at Europe. Europe's going to hike into a supply shock. You look at the data in Europe around consumer confidence, ZEW, like you're seeing a tangible slowdown. I just think if you're a central bank, you got to be a bit anticipatory of, I heard somebody say the other day, what happens with commodities, price adjusts commodities and demand adjusts in terms of what happens. And I think you just got to be a bit thoughtful and look at the whole picture when you make that decision. And, quite frankly, I think going forward, I think Chair Warsh, be very thoughtful about, do you have to keep moving the funds rate around to tweak small moves, particularly when it's supply shock driven? My perception would be, my perspective would be, look at the whole construct. You don't have to constantly adjust, and be thoughtful about where the puck is going.
Hey, we've been talking a lot on this program over the last week, Rick, and over the last several months about pulling money out of private credit, and now it seems to have spread to private equity, and then redemption gates coming down. We talked about Cliffwater, right, 17% withdrawal requests. You had Partners Group seeing that creep over into private equity. Yesterday you had Blackstone talking about redemptions and gates as well. It seems to be the only crack here that I see in financial markets. Is that a concern?
No, not. I mean, not. So, is it a concern idiosyncratically? Yes, in some parts. We've talked a lot about software, et cetera. Is it a systemic shock? No. I mean, I've gone through, where you have. First of all, it's term financed, versus you go back to the financial crisis that was largely overnight funded. So, no, it's not. It's not systemic, and the sheer size of it is not that large. What, quite frankly, it has done for portfolios and how we think about investing, the needle has moved around opportunities. If you go back the last 2 years, there was so much money floating around that privates were trading at very rich levels in credit. And now the opportunity set is much more robust. I mean, now you've created normalcy, which I think is awesome. Like now, all of a sudden, you have, the dynamic of if you've got an illiquid asset, you should get compensated for that. And now you're starting to see that into the equation. So no, I'm not worried about the systemic at all. In some names where you have debt that needs to be rolled, you got to be, obviously, you got to watch it. But definitely not from a systemic crack in the system. I'm not worried about it.
So I'm going to talk to Kevin Hassett on the other side of this break, Rick. What would you ask him right now? I mean, you mentioned the cake-shaped economy. What questions do you put to Kevin?
Yeah, I mean, I think he's been very thoughtful. I just saw a headline about, listen, I think you have to, think about the broad picture and give the system some time and think about what the interest rate tool does versus liquidity versus balance sheet. Listen, I think that's really important, is think about, how do you think about, there's a lot of treasury issuance that's got to come to the market. You got to make sure that the back end of the yield curve is contained. How would you think about that? How would the Fed think about that? To me, I mean, financial velocity today, it's not really created by the overnight funds rate. It's out the yield curve. It's where we finance commercial real estate, residential, corporate. Like, that's a really big deal. And, hearing, how does the administration think about it? How will the Fed think about that? He's very thoughtful on these things.
The new chair, Kevin Warsh, in 2024 said central bankers around the world seem to be more comfortable with inflation closer to 3% than I wish were the case. That's very dangerous stuff. We can have an economic boom in that scenario, but there will be a high price to pay. Do you think this central bank is comfortable with inflation where it is?
And so I think there's something that's important, the momentum of inflation and what is driving it. So if you look at the rate-sensitive parts of the economy today, and we break down inflation, you say, what's rate-sensitive? Obviously, shelter is rate-sensitive. We need to build more houses in this country. Obviously, you take things like used cars. What's interest rate insensitive? Things like healthcare, education, insurance. Those are sticky high. But the interest rate tool doesn't really do a lot with it. It gets to this point about the headline versus what actually is happening. And I think you just got to factor in, if you're a central bank, if you have a supply shock where that should abate over time, and if your tool isn't really effective for some of it, then I just think you have to think about what is your tool doing. Maybe the monetary base should be adjusted, maybe the balance sheet. But I think you have to have a broader discussion around it. Listen, today I think the central bank's inflation is above target. You got to wait. Maybe the ECB hikes a bit. But I just think the simplistic top line answer for these, which are complex subjects, I think is a bit superficial at times.